How can advisors educate clients about the importance of portfolio stability and diversification amid the government shutdown? Hi, I'm Joel Dickson. Today, we're discussing ways to help clients navigate the uncertainty brought on by the government shutdown and guide them in interpreting the potential risks without overreacting. I think in many ways, whenever there's a change that's experienced in the markets and in the economy overall, ultimately how it affects your clients and therefore your discussions really comes down to, has anything changed with your goals of how you want to use your money? Has anything structurally changed with the markets that would affect your ability to meet these goals? I think in these cases, with the current government shutdown, the answer is probably no. And in that case, then the plan that you have in place yesterday probably still fits the client's goals and objectives to meet into the future. So whatever the role is of the different investments, probably unchanged. Goals of the client, probably unchanged. And so when you think about the impact to clients, there will certainly be quite a lot of noise, discussion. What is the potential impact? Likely we will see some volatility in the markets increase with this uncertainty of how long the shutdown may occur. But that volatility is really just reacting to the uncertainty of the overall markets over this period. And again, comes back to, is there anything structurally different in terms of your client's goals or your expectations for your investment strategy and portfolio to be able to help meet your client's goals over the long term? Most likely, those answers will be no. And so the stability and diversification that you've built into your portfolio today should probably continue and be useful going forward. There have actually been a number of shutdowns over the course of the last couple of decades that provide some guidance and maybe even some understanding of what might happen with markets during these periods. The kind of headline version of this is that there's really no clear relationship between shutdowns of the US government and market returns, either on the fixed income side or on the equity side, and either short-term or long-term. Yes, you were likely to see and experience an increase in volatility of kind of daily market returns as uncertainty reigns in terms of how long the shutdown may occur, when it might end, and what implications that might have. But over the long term, there really isn't anything particularly tied to structural changes in expected returns. I think it's really important to note that even during the shutdown, the government's ability to pay its obligations continues, and it continues to provide essential services to people like paying Social Security or Medicare reimbursements. What's a little bit different with this shutdown is that unlike some of the previous shutdowns, the discussion and the debate does not include debt limit increases for the US government. And that's why there's no question in this shutdown about the government's ability to pay its obligations. And because of that, that's likely to reduce the overall impacts on markets, both during the shutdown and moving ahead. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.